Hey everyone, and welcome to another episode of the Open Conversation. And I am excited for today's conversation as we are going to be talking about funding, startups, raising funding, and debunking some of the myths that have been around in the startup space. And I'm excited to invite today's guest up on the platform, Will Green, Will from Grindstone XL. Will, welcome to the Open Conversation.
Thanks, Rania. Good to be here.
Yeah, you've been around in the startup space for some time, right?
Yeah, I think it all started 2006 personally for myself, and then more recently for the past 3 years, actually working at Grindstone, which is a scale-up accelerator. Helping to accelerate the next generation.
Yes, and I mean, a lot of people know if we talk about accelerators, they know about Y Combinator and the like. So, what makes Grindstone different, and what does the accelerator do?
Sure. So just to kind of debunk the sort of the terms, like you obviously get sort of an incubator, which generally sort of incubates the idea with the entrepreneur for the product, and you generally will sort of get a sort of a very sort of basic product, a MVP, a minimal
Mm,
viable product, and then an accelerator sort of takes it on to the next level. So
mm,
generally you'll get a startup accelerator, which will take it from the next step from that idea to product market fit to getting customers, and making the business sustainable. And Grindstone is positioned very much on the sort of scale up stage, so a little bit after the startup stage.
mm,
So a company who's already got some customers, definitely got version one of their product out, and looking at sort of possibly building more features onto their product. And yeah, Grindstone has been going for the past, I think it's 10-year anniversary this year.
wow.
It kind of got incubated out of Knife Capital, one of the sort of
Mhm.
leading sort of VCs in Africa, and based in Cape Town. And it was what's different. Obviously, you mentioned Y Combinator, which is the famous one where sort of Stripe and those kind of brands got incubated
Mm,
out, and 500 Global. But what we did with Grindstone was make sure that it was an equity-free accelerator, which is generally you can participate, but you're not sort of diluting your most valuable source of funding, which is your equity. So that's
mm.
that's it in a nutshell.
Okay, I love that. And I mean, the word accelerator actually practically just explains what it is. Right? It might take you
Mm.
2 years to reach a certain stage. If you join accelerator, maybe we do it in 6 months. Does Grindstone have kind of a guideline of how much you'd love to accelerate the startup's progress?
Yeah, so the one thing is, if you go to the website, you'll see that we do measure everything. So we'll measure the number of employees that the company has before the program, and then also afterwards. Obviously, the revenue growth, the compound annual growth rate as well. So we're very sort of meticulous to ensure that we are actually helping these companies accelerate. So we're not just drinking our own Kool-Aid, as the saying goes. So for us, the program is a little bit longer than your normal sort of accelerator
Mm,
programs. Ours is a full sort of 9 months, 12 months, if you consider all the sort of help that we do with access to markets, access to funding. But yeah, it is a longer program. But by that stage, we know the entrepreneurs. We built the trust, and also we can really help them. So it is all different for every single entrepreneur. Some might
yeah.
need some more help on their legal side. Some might need
Mm,
help on their financial models. Some might need help on their marketing and sales, which is
mm.
generally all of them.
All of them, yeah, okay.
But yeah, that's it in a nutshell. Yeah.
Okay, great. So a lot of founders, when you speak to them, they'll speak about their challenges in raising funding,
Mm.
and I think one
Yes.
of the most common things is there's this disconnect between what founders are trying to do, which is get money so that
Yeah.
the business doesn't die,
Yeah.
and what VCs are trying to do. So
Yeah.
maybe share a bit, like in your experience, like what are VCs generally trying to do? And I know they have different strategies, but I
Mm.
think if startups better understand what VCs do and how they do it,
Sure.
they'll have a better idea of how to present themselves to these
Yeah.
VCs and make it more attractive.
So basically, it's a form of investment. So you'll have your sort of normal sort of, call it your bonds, on the sort of more less riskier side. On the more riskier side, you'll have your sort of private equity as well as your venture capital. So it's generally the sort of funding which is a little bit more around risk. These companies are early stage. But what's quite interesting, which most entrepreneurs don't appreciate, specifically in an emerging market like South Africa, that VCs are actually entrepreneurs themselves. they've got to raise funds from an LP, a limited partner, be it a sort of a bank or anyone like an institution, a fund of funds as an example. But then also they've got to convince startups to say, hey, we want to invest in you. So they are building a marketplace business. They're building two sides of the coin.
Sure.
So that's quite interesting. But just to answer your question, most VCs, and this is the most important thing for founders to know, have a mandate. And it is a case of these are the criteria that we've told our limited partners, the people that given us the money, we will invest in. And this is our unique sort of skills, or our unique focus. Our thesis is that this is where there's going to be growth in the market. So essentially it is about that. And generally, most VCs, they can't guarantee it, but will target an IRR, it's an internal rate of return. So it's how much that money will grow. But the thing is with VC is generally, in a portfolio, you'll get those that will return. I think 50% of most of VC portfolios, won't return, but it'll only be the 5% of your portfolio that will generate the returns that you need. So the bottom line is a VC is looking for an investment that can return their fund. So you've got to be presenting your business in that regard, not sort of a nice to have vitamin business. You've got to be a painkiller. You are serving a big pain in the market, and you're not just a nice to have sort of vitamin that doesn't really move the needle.
Yes, and I mean, speaking about moving the needle, like I mean, what is moving the needle for a VC, not an early stage VC, but a later stage? Like, are we talking like 10x on their return within 5 years, or more than that?
Well, to be honest, what's happened recently, we've got to kind of acknowledge the elephant in the room. There's been a complete sort of write down of valuations. So there's been a change over the last sort of, I'd say, within the last 12 months of actual sort of basically supporting their portfolio companies, to sustain themselves, but and therefore there's been a lot more focus on capital efficiency, so how much money has that startup raised, and how much revenue on an annual basis are they generating? And generally, if you've raised a lot of money, but you can't see what that money, how much that money has created in value, that's always a sort of a bit of an orange flag or red flag. So yeah, I think it all depends on. It's a very hard question to answer, because depending on where the audience is, it could be in the US, it could be in the UK, it could be in South Africa, but generally, people always talk about a 10x return on money, which is generally sort of the gold standard. I saw a post yesterday, most will be happy with 5x, but at least 2 or 3x is what some of the funds will generate.
But that's interesting, because it actually kind of gives a framework of what one should consider when you actually attempt to go for VC, right? Because
correct.
If you think about it and you go ask for a small amount of money, and even a 10x on that money is not really going to make a massive impact on the fund. They still need to support you from a portfolio management perspective. They still need to, pay legal fees and do all kinds of other things. So, and that's why a lot of founders are getting, sorry, this isn't big enough for us, right?
Yeah, exactly. And I think exactly to your point, I think it is, you do need to, I think there's two things entrepreneurs need to do. And that is, one is have a vision, so have a very big vision of where you think you can take your business. And it's got to be big. It's got to be, you really got to back yourself. That's why you've taken the plunge and the risk. And then the second thing is execution, like how do you execute? And this is generally the stuff that comes out in the due diligence. Like, do you have a pipeline of sales? Like, what is your conversion rate on your pipeline? What is your sort of your sales cycle? How many days does it convert a client? So that a VC knows and most VCs are it's growth capital. So it's money that goes into the company that basically helps the company grow. Most entrepreneurs think, it's going to be VC money, but then you take some of the money off the table, which is fine. Some VCs will be happy with that, but most of the time it's making sure that money can help to grow the company that the VC backs.
Yeah. So question, I mean, if you find a startup that is doing something and they've got some customers and they're making some revenue, not profitable, still burning a bit. and you look at the idea and you go, look, this is the idea isn't big enough for VC. Is it actually possible to make that idea bigger, or is it, it kind of has to be something big from the start? Like,
Yeah, I think it's I think most founders sort of fail when it comes to kind of validating their product, and not interviewing clients before you even build anything, so
yeah,
you've got to you've got, and I think nowadays there's so much information available to justify that there exists this big market. So it's, and generally to your question, most founders will pivot to say, okay, well, let me, we were sort of a health tech company, but now, we believe that payments could be a key challenge. But it's pivoting for the right reason, and also having deep domain experience in that field. Not just pivoting for the sake of, you might get a check if you suddenly sort of put fintech next to your name, but the fact that you are actually solving a big enough problem.
yeah. So what
Or a startup that solves energy, reliable energy sources. That's a good one.
I
As
also
you
just
saw the
had my
lights
load shedding switch
go
over
out,
here.
and luckily we got power backups here.
Yes. So I mean, you say you can't just put fintech and raise money. So question: can you put AI currently in your environment and raise money?
That's the latest one, but again, it's being able to, like, properly justify and have people on your team who actually, know how the different sort of platforms work, and data scientists to label and crunch the data.
Yes.
We are seeing sort of themes every single year. We see a sort of a new theme, and obviously
Yeah.
sort of AI is one of those, and specifically now with Chat GBT and how that's kind of ignited the interest in the space. It's
Yes.
going to be amazing over the next couple of months and years. Yeah.
Yes. All right. So for everybody watching on LinkedIn, you can pop a question there in the comments, and we can bring it up on the screen. And if it's not too difficult, we'll try and answer it. And it's always fun to engage with those watching. So please be sure to pop in some questions. But let's continue around the conversation of VC. Well, there's sentiment among founders that there are simply not enough VCs giving out money, right?
Mm.
But there's also a sentiment more on the VC side saying they're not finding enough good deals,
Mm.
right? And I think there's merit in both, right?
Yeah.
In your experience, like how would you unpack that?
So I kind of sit in between that, because as a kind of a accelerator who's obviously affiliated to Knife, 50% of Grindstone is owned by Knife, but I also work with other funds, if there's not a mandate. But
Yeah,
likewise, I'm an entrepreneur myself, and I spend a lot of time sort of coaching entrepreneurs to get them to a stage where they can apply to Grindstone. And we've had some success stories where 2 years before Grindstone, I've sort of coached those entrepreneurs. So to answer your question, it is economics, it's supply and demand, and generally with VC, it is a sort of a marketing thing, in the fact that, the sort of the well-branded or well-regarded sort of funds will get access to some of the best sort of deal flow, just purely because it is also signaling, depending on the sort of the funding strategy or plan of that company, but the most ideal thing for a founder is to know the game, and the rules, and so you can sort of play behind it. So it is a case of, there's always going to be an angel or family, friends, and fool, or bond in some cases in South Africa. But then it comes down to sort of finding the seed funder or an accelerator, and then also your next funders. But I think it does boil down to just, we have a saying, just be awesome, build an awesome product, be focused on that. And fundraising is a constant thing. I think as a founder, there's many hats you wear, and the three big ones are actually you're chief sales officer. You have to be selling and getting customers, because if you do have customers, that's the best case, is you bootstrapping. You don't need to raise funding, if
Yeah.
your product is so good and the positioning is so amazing. Also, you've got to be, obviously, always be funding, chief funding officer the whole time, because it's like a sales cycles. You've got to constantly feed the funnel, with regards to meetings and pitches and so forth. And then finally, it's just talent, because when you do get that funding, you actually have to build the team. So I always see founders who actually don't do the last piece. And a little bit of advice is, if you've got a founding team, is, like really ensure that people have a target to say, listen, your job is to find 10 amazing humans that, should we get this funding, we would hire them, so that you're having those conversations, so that when you do get the funding, you can grow your team.
Is that something that VCs typically find interesting as well? Like, you go, look, we're currently 2 people, but we have these people, we've had conversations with these people, they're kind of ready to jump on board as soon as we raise funding?
Yeah, definitely. And also there's co-investing. Like what's happening a lot more of is people, because as you alluded to, in some cases, for getting funding from VC is like, it's even longer than a marriage. You've got it. You're there for the long haul. So finding sort of co-investors who have a specific domain expertise, who can really help you, is also key. And I always say, this is the kind of saying I said, it takes an ecosystem to raise a startup, from the university incubator to the accelerator, to the angel investors, to the corporates who are sponsoring some of the sort of the pilots, as part of their innovation program, to the VCs, as well as to the consultants and the exit advisors and mergers and acquisition people, So it is a bit of a poiky pot of people, when it comes to domain expertise, but that's it.
Yeah. So one of the points of VC is obviously to get an exit, right? A liquidity event. They can look in different shapes and forms, and and I think that sometimes that founders forget. Like, we need to build this thing to a specific point so there can be a liquidity event. So on that point, we've got a question here on LinkedIn from Al Vaughan. He says, talking scale and scope, what are some recent successful VC and growth stories? And I think he really means what you've seen recently. Any liquidity events? Any?
Talking to your point, I'll just sort of front loaded with some data, but the bottom line is, Africa as a market only attracts 1% of global VC. Okay, it's only, what is it, $6 billion. The total population of South Africa is like 17, of Africa is 17%. But what that means is that if a venture firm or a fund manager, wants to see the market as a growth market, every year there has to be liquidity of that equivalent amount of funding that comes in, just to kind of wash over. So every year there has to be liquidity in the market, to the tune of $5 or $6 billion in trade sales, mergers and acquisitions, or IPOs and listings. So in order to really demonstrate, take a helicopter view and look at the market, in order for it to be a healthy, sustaining market, you do need like exits. So you have to you almost build the business to actually understand, well, who am I going to exit this business to? And founders have to think that, so that you don't take funding from those people, because that will limit your potential to exit them. So that's also quite important. But just some recent stories based on that. I think South Africa in general, based on the ecosystem in emerging markets, and this is sort of documented by many of the media publications like Tech Cabal, as well as the sort of Venture Burn and so forth, is that South African companies actually, or South African ecosystem delivers quite a few exits. We build very good businesses that get sold. So some of the recent ones, specifically in the Grindstone cohort, we've had some very good successes. Interviewed Jonathan from Payfast. He exited to DPO. That was one of the successes. About 2 years ago, we had WizPass, which was a visitor management software company that sold to a US company, FM Systems, and that was led by KKR, a private equity business that was doing a sort of a portfolio play in that particular industry. Nona recently sold to Yoko, which was an acqui-hire business. So Mike Scott and the team there did well, and they're friends of Grindstone, because they were also on Grindstone, and we always invite these Grindstone founders back to share their lessons on their journey, which was a poolside chat function that we have in the workshops, which is always very, very useful, very well regarded. Also, OneCard exited to Massmart. So those are some of the sort of the the success stories. But the one that I'm very sort of one of the sort of cohort companies quite recent last year actually, and it's more of a growth story, not like an exit story, but Loop, Kimberly Taylor and her team built the the logistics platform for Checker 6060. So if you've ever ordered anything on Checker 6060, the software that solves the traveling salesman problem, which is a mathematical problem, was written by Kimberly to help fulfill that within the hour, which is their promise. So and during COVID, the growth of that company went through the roof, as you could imagine.
Awesome. So does VCs take the lead on trying to find that liquidity event? I mean, are they constantly on the lookout? Because it's quite diverse, right? I mean, in the US, you have teams that specifically build towards IPOs. I
Yes.
mean, frankly, I'd love to see more tech IPOs on the JSE.
Yes.
But the scale really hasn't gotten to the point where it makes it viable in South Africa. So I think the first question is, do you foresee that ever becoming something that is a viable exit in South Africa? And then secondly, do VCs take the lead on finding these exit opportunities and so that the founder can focus on building the business?
Yeah, well, definitely they should. I think they need to, depending on their mandate, they have to return a value to their LPs. So generally, it should be a part of the strategy. Because generally a VC firm lifetime is about 7 to 10 years.
Okay.
So generally they are, and you do have specialists who do sort of mergers and acquisitions sort of advisors. We kind of, as a Grindstone, has acted as that sort of function for some of our Grindstone companies, because we know the founders and we can help them sort of put their best foot forward. It is always advisable to get like an exit advisor, because ordinarily there'll be sort of an earn-out point where you join the company, so therefore it helps if you're negotiating via someone, as opposed to, because your potential employer is going to be on the other side, if there's a success. So generally, and just obviously speaking from a knife perspective, they've got a philosophy which is find, make, grow, and realize. The realize point is realizing value for the GPs, but for the LPs first, and the GPs and the general partners, which are the partners who own the VC fund. And the general business model, also just to share with people, with VC, is it's something called 2 and 20. So essentially, there's 2% of the fund value which goes as a fee every year to pay for the salaries of the people that work in the firm, and then 20% is basically the carry. So that means that once you've returned the fund back to the LPs, if there's been an exit or sort of a secondary sell, then 20% of the profit over and above that return gets distributed within the VC firm, depending on what the GP partners, the general partners, whatever their percentage stake in that firm is. So that's how. So it's kind of a retirement annuity for VCs is the carry, building value for future wealth. Yeah.
But that's quite interesting, because it already gives a lot of indications as to, I mean, if you look at a fund, right, and you can see they're 100 million fund, and you assume that they are applying 2 and 20, you can already derive some things around what kind of deals they're probably looking to do, right?
Yeah.
Because they'll have 2 million rand in fees, which is not a lot.
Yeah.
A VC on, right?
Correct.
And which means they're likely not going to be able to do a lot of portfolio management, because they will be small staffed, right? So that VC will probably throw money at a lot of different things and see what works, without having to apply too much personal attention. Where, if it's a 500 million rand VC, they'll have a little bit more in terms of supporting these startups. But then again, so it's getting that balance right between how much you have in terms of support, as well as who you invest in. And I guess that limits them from making certain kind of investments.
Yeah. So and Ken always says this. He always says, when he speaks and presents to the Grindstone companies, he says, like, I'm speaking to my future bosses, because essentially also when founders sell their business, they will eventually sort of do some angel investing or put some money into like a knife fund, because it's kind of, they want to keep active in the ecosystem. But it's a very good point. That's why sort of VC funds are always sort of raising new funds, you just have to add up the value of the funds and multiply it by 2%, and then
Yeah.
how much that company, that VC company, is earning on an annual basis, which then gets dispersed amongst for the operating expenses of the firm.
Yeah, and it's often way more than most startup founders know, right? I mean, legal fees,
Well,
due
yeah.
diligence fees, those
Well,
things
yeah,
are.
it's the legal fees, and to be honest, like that's why Grindstone exists, because in order to have a seed fund in an emerging market, it's the funds are going to be quite small, and therefore Grindstone is almost a protracted due diligence. It's like you get those like milk tart or these like apple crumbles, at a fancy restaurant. It's like a deconstructed, milk tart, like this is Grindstone is the deconstructed due diligence for entrepreneurs.
Love that. So there's another strategy which I found is really interesting, and it's what Zach George is doing with Launch Africa, which is let's go far and wide and do as many deals as we can. That obviously fits a mandate. I mean, I've seen some of the investments, and I think he's backing some amazing founders. Why do you think not more people have that approach in Africa? It's certainly a way that Americans approach it in the VC space, specifically in the early stages. Like, but what Zach and them are doing is for me is quite interesting, because it's the first time I'm seeing someone that spent some time in Africa in the startup space really taking the American approach of far and wide, making as many bets as possible. Do you think that's going to be a trend going forward? We'll see more of that in Africa?
Yeah, the bottom line is, like I shared, we need more money in the market, and I was recently at an AWS event last night, and we were just like saying, like, what do you guys need? And effectively, it is the capital in the market, because if there is capital in the market, you can hire the best, brightest people. It's a signal to the potential data scientists that this company is going to be around for the next 2 or 3 years. It's not going to be having to scrounge for funding. So capital does need to flow in. So whatever model works, and I'm not too sure of returns and so forth of all the different funds, but yeah, I think definitely having a sort of if you're investing, make sure it's a decent sort of check size, that you can get a return for your LPs, and yeah, there's also just so like as a percentage in Africa, I think 60% of VC funding comes from the US, 20% of that is from within Africa, and then the rest is kind of a little bit of Europe and Asia, the other what is it, 20%, yeah.
Yeah, that's very interesting. So, tell me about mistakes founders make. Like, I mean, you work with a lot of founders. Like, what are some of the most common things you see?
So I think it's what makes a good founder for me is actually coachability. So you need an element of self-awareness of these are my weaknesses. There is an element of like fake it till you make it. Yeah, sure. Like build it. They will come. But at the end of the day, when it comes to getting advice from an accelerator, an advisor, anyone, it is really about taking on that advice based on the experience of the person giving you the advice as well. So that would be number one. I think also I've been through the journey. It is a roller coaster. It is. I think 75% of all founders have some sort of degree of mental sort of unease. So to actually surround yourself with people that can support you on that journey is very important. Look after your health, sleep, those types of things, so that you have got the energy to build the business. You need to be looking after yourself first, because effectively you are the business. And then sort of secondly and third, I think through the many we get literally, I think almost about 800 sort of applicants a year for each program. So we see a lot of the data, and there's sort of 220 questionnaires that we ask the founders to fill out. But generally the gaps that we see in the businesses, we take a very sort of scientific approach to engineer growth for these companies. Is number one is sales, and number two is marketing, and then obviously number three is strategy. So I always hear sort of from an entrepreneur who's built a great product, but has not sold it to a client, and they want to outsource the sales to someone else. It's like, no, you need to sell this because you are the business, and at the end of the day, you're the one that an investor or a customer is gonna be backing. So I think get good at sales, and personally, that's one of my passions is to teach sales and to actually ensure that these entrepreneurs, don't necessarily need the funding, because the worst case scenario is that you get to a Series A and you don't own your company. So that's another advice I see is specifically in emerging markets, because the time frame is a lot shorter. So entrepreneurs will actually sell their business, too much of their business away. So where possible, look after your equity, and if possible, get some grants, win some awards. I know a very successful entrepreneur who built his whole tech stack on winning awards and getting grants. So there are ways in which you can do that, and that in itself shows the hustle and the quality of the entrepreneur. So it's got a data flywheel there. Sorry, I'm using a lot of Amazon sort of references. It's just kind of fresh in my mind.
That's awesome. So the sales and marketing thing is interesting. I mean, anybody that's done or engaged with any kind of American startup that's on the rise and doing well, they just have a natural way of just being better at that, right? They're confident in their products. You feel pitched to, but you don't feel violated. Like
I will disagree here. I think always a conversation is always good when there's a little bit of disagreement, but I think I recently went to Singapore as part of the Switch event, so Singapore Week of Innovation and Technology, because Grindstone, we're actually running a Grindstone Singapore event for Singapore startups. So we're kind of taking more of a sort of a license model of growing Grindstone and how we grow the business. But it was quite interesting. I think the difference with African startups, South African startups in particular, and emerging markets in some ways, you're solving a big problem. Whereas in America and other sort of economies, there's not as many problems to solve. So you get a lot of likeness, and logos start looking similar. Value propositions. No, we are the Uber of that type of thing. But I do find that entrepreneurs are sort of really, if you're focusing on solving a big problem, and you're getting some way there, that's positive, because you can potentially save lives or eradicate poverty or whatever that big thing is that is your sort of massively transformative purpose or your vision for the company. So that's one thing, and I think for me it's but it's each to their own, and it's learning about different ecosystems and the different entrepreneurs that exist in those ecosystems. But we do breed very resilient, tough entrepreneurs here, which I'm always backing.
So that's actually interesting, right? Because now in America we have a lot of founders that are successful in selling what we could argue is kind of vanity things, right? Like things that we don't really need, but people use it, and they buy these things. Everybody buys too much in America. But they're confident in sales, and they're successful in sales. So come back to South Africa. We have founders building amazing things, but it seems like they almost have no confidence in going out telling the world that what I'm building is awesome.
Like, why that's something I think like AWS, the EC2 cloud, the elastic cloud computing technology that basically fueled Amazon's growth, because AWS is a big part of that. That was developed in South Africa by a South African developer. I think that it comes down to a sort of a mindset, or also because we're down south or on a different continent. We're very far away from the market. So I would say it is really about having this deep belief in yourself, and I see it in different ecosystems, like in different universities will breed different entrepreneurs who actually do think global. So and I'm seeing this in different cities in different parts of Africa, in the fact that if you look at Cape Town being a little bit of a mature ecosystem, a lot of fintechs and edtechs, they're looking at sort of validating their business in Africa and South Africa, but then expanding it into Europe and the US. So it's looking at sort of 10% local, 90% offshore, and then you kind of benefit off the currency difference with the cost in local currency. Whereas It's a very similar model to how Israel's been very successful, but Israel's very intent of focusing on the US market and listing on the NASDAQ. That for them is the way in which that you create wealth, and it's worked for them. So I've got a lot of respect for their ecosystem, and I've got a lot of friends in Israel who have built some amazing businesses. So it is a case of focusing on the market sizing of the problem you're trying to solve, and thinking not just in your local context. I think it is, but at the same time, can this problem scale? Is this a problem that we're solving for that everyone on this planet deserves or has?
So founders that come into Grindstone, which you see have they're solving important problems. They've got a few customers, but they're struggling with sales and marketing. What would your typical thing be in terms of helping them, or how would you think about it? What would you encourage them with, or where would you start?
I think it all boils down to almost doing a proper sort of almost assuming that you don't know about the company. Do it from a consumer point of view. If you are sort of a head of procurement of ABSA, and you hear about this Grindstone company, what do? You check on Google, you see, is there a website? Okay, tick. Who the individuals, is there a social media LinkedIn platform or profile of the individual or of the people behind that? So it is a case of the basics, and a lot of these tools are available, and also putting your best foot forward. A lot of the time it's looking at your corporate ID and saying, well, can it be refreshed? Do you have a signature? Do you have, a nice logo? And then looking at and then from that point of view, just as a sort of normal, okay, cool, this kind of ticks the box when it comes to, okay, this looks like legitimate, and then it's a case of looking at the sales material. It's kind of show me the presentation that you do to a customer, and this is also something that I see a lot of, is that some founders will use the same presentation to an investor and to a potential customer. Those are two completely different customers and customer personas. So I think that would be it. It's just looking at what have you got, and then also looking at your financials, saying, okay, over the last 12 months, where have you generated revenue? And I've got the saying, fish where the fish are. If there are certain types of segments that are buying from you, then double down on that, and then also if there are new segments that you want to target, then focus on those. So that's the kind of approach that I take. But generally, and B2B, and you obviously get B2B and B2C, B to business, but business to business, business to consumer, it's a completely different sort of offering, because now you have to invest in marketing to the end consumer, and generally the best way to do that is B2B2C. We're looking at a strategic partner that already has your customers, and how you can and have a win-win relationship with that strategic partner. So that's it.
That's awesome. And you speak about B2B2C. I think something that's extremely underrated is distribution networks.
Definitely.
I saw that the other day of how Microsoft Teams just shot past Slack in terms of usage, because for years Microsoft has had this amazing global distribution network.
Yeah.
And even a product that might not be as well-rounded as another product, you can get substantial traction just by having a good distribution network.
Yeah, and this is a great exercise, and I encourage anyone who's an entrepreneur on this call. It's a really good way to get leads and customers. And I always say that business isn't about what you do or how you do it. It's actually who do you know that basically can drive your business forward. So I've always do this exercise when I do a sales module, and it is a phase of going onto your WhatsApp and scrolling down all the way to the bottom of your messages. Everyone who you've had a message with is someone that knows you or knows of you, and you've had some engagement. And you just basically start activating your network, to say, hey, how's it going? I'd love to come and chat to you about my new startup and get some advice. Because there's a saying, if you ask for advice, you get funding. If you ask for funding, you get advice. If you haven't quite cracked the sort of the product market fit or the product, investor fit, if you want to call it that.
Yeah. That's really good advice, and I mean, I think that's probably where a lot of people should just start. Is just ask someone.
Yeah.
can happen is someone says no.
Yeah.
And getting to a no is actually way better than never knowing whether or
Well,
not.
that's it. And most, I think this is also, sorry, I'm getting a bit philosophical here. This is what happens when you're a father of teenagers. But again, like there's kind of three fears that every human has. First you're born with fear of noise and fear of falling. Those are kind of embedded in your DNA. But fear of actual failure, fear of rejection, and fear of success. Those are the only sort of embed fears that you have. And the problem is with sales is it's a fear of failure or rejection, or more rejection. So you've got to get out of your way and do that, because that helps to build momentum in your business. And quite interestingly, the fear of success is something that we see with some founders who are raising capital, where suddenly they're starting to not sort of have a bit of deal fatigue, but purely because they don't believe in themselves that they could be successful. So that's a kind of a bit of a negative, when it comes to that. Yeah.
So speaking about that, I mean, it actually makes me think about, like, sometimes, you have a founder and, or let me put it this way. If you go on a track of building a company that's going to IPO on the NASDAQ, right? I mean, you're saddling up a certain kind of horse, right? And that's going to mean something for you personally. Like, a good example would be, I mean, I have the world of respect for Elon Musk, but I absolutely don't want to be him. Like the kind of workload that he's under and how he operates is just not something that's desirable for me in life, right? But the same goes for raising VC, right? What are some of the things that founders need to consider when they make this move of taking money from VC? Like what are they signing up for?
So it's it is essentially, like, you get smart money, you get dumb money. Dumb money is just money. Smart money is money with knowledge, networks, whatever that might be in your space. So knowledge could be, okay, knowledge of how to get a strategic partner, or possibly, there's a portfolio company that you want to work with, and it's a portfolio play for that. So effectively, like, you need to be. Sorry, just repeat the question in my mind.
So as a founder, if you're raising funding, like, what are you actually personally signing up to? Are you?
Well, it depends if you also have a board seat that you're giving up. So there's a lot of sort of governance that you got to now put in place. There's a board meeting that you've got to prepare for with a board pack, and essentially the board members, depending of how many seats you get, they're there to help you. So it is less of a sort of it's more about presenting the business where it is, and then if there are things for discussion where your board members can add value, that's it. So like I mentioned, it's smart money. It's people who are actually as enthusiastic about your business as you are. So and someone who can be there through the ups and the downs, but the most important thing as well, which I see a lot of founders doing, is communication. So to communicate early when things are not working, like we've just had with COVID. If suddenly you don't have any events to ticket to, like, what do? You've got to sort of make plans. And to be honest, those are some of the best entrepreneurs. Like, nowadays, all you have to do with an entrepreneur is say, like, what did you do during COVID? And that will really tell you about that individual. They probably bootlegged some booze, or probably like pre-sold some sort of new product or feature that they were launching, all acted quickly and actually sort of did deep cuts. That's always a good question to ask as well.
Awesome. So let's talk about metrics. Like, let's say I'm building a startup, and our newsletter is a startup, which is a startup.
And congratulations, I'm a subscriber, and everyone on this call should be subscribed to it. I'm doing a plug here, and it's completely unpaid for. I'm like disclosing that.
That's awesome. Thanks, Will. But we're building, there's plans to build this into a bigger company, right? And at some point, I doubt it, but let's say at some point I need some VC money to take it forward. Like, what would metrics be? Like if you're and in fact, any startup founder listening to this right now, they're busy building a business. They're looking at a few metrics, but what are the key metrics that are absolutely have to be in place for a VC to consider them?
Yeah, so it's working backwards. Okay, so when there's a valuation on your business, and you want to actually ensure that you've got a high valuation that the VC will buy into, it is a case of looking at there's a report called the Software Equity Group, SEG, and basically it puts multiples on your EBITDA, your earnings before interest, tax, and amortization. So it is a case of looking at how in what category is your startup? That's a key question, because generally, like we've seen with AI or remote working software or video conferencing software, there'll be much higher multiples on that. Whereas if it's maybe in some sort of form of service business, there won't be that much multiple, and it's maybe an acqui-hire business where you're just paying an amount per head that is employed by the company. So the first thing is ensure that you've defined in what category your company sits in, who are your competitors, and a lot of these sort of have been defined, and working backwards at that. So it's picking one that is where you are, but maybe it's and the multiple on the EBITDA is high. So that's one piece of advice, and then it's to work backwards. I think that generally recurring revenue businesses, will have a much higher multiple than a sort of a project or service-based business where you can't forecast the revenue. Probably double the sort of multiple in that case. And then essentially, the key things to look at specifically in this environment, I mentioned your capital efficiency. How much have you raised, or how much money have you put in the business, and what has that generated from an annual recurring revenue perspective, and definitely get to a point where it's over one. If you put your revenue over your capital efficiency, make sure that your revenue is much more than how much you've raised, and you're above one. And then it is just the most basic things is it's looking at your customer lifetime value. Like on each customer, like if you minus all the cost on it, how much money of that is actually flowing in your bank account, and that will then determine, okay, well, maybe your margins aren't so great. So it's knowing also what your margins are. And then from that, it's because from that money, it's going to be, okay, well, what is our customer acquisition cost? So if it's very low and you're pulling out lots of money, then that's a great business, because now you've got all this money that you can invest in marketing, in hiring people to really drive the engine. So I think someone said, I think it's David Sachs in the sort of All In podcast said, during a sort of a bull time, it's all about growth. But at a time like this, it's really about your margins. It's looking at your basically your customer acquisition costs, and looking at your lifetime values of your consumers. So that's just it, sort of quite broadly, because also if you're not spending money, or if you've got low customer acquisition cost, that there's inbound interest. People are just buying what you're putting out there, and therefore you can increase your price, because you've maybe got a category of one business. There's no other competition that does what you do, so therefore you can charge a premium price on that. So therefore you can bake in margin or some costs for marketing and to get ahead of your competitors. So does that answer your question?
No, it does, and I think that what's nice about it almost gives a framework. So anybody listening to this, if you have those numbers in place, the objective really is to iterate on that and improve that, right? Increase your lifetime value, reduce your cost per acquisition. If you reduce your churn, which is another one.
Yeah, churn is another one. Sorry, that's another one as well. Yeah.
So it's actually it helps you with your blueprint. Like, because I think a lot of founders, there's so many different things to do. It's like, well, what do I do this week? It's like, well, why don't you just focus on getting your lifetime value up, or why don't you just focus on getting your cost per acquisition down?
Yeah, and the key thing also, and I think the guys at Duolingo do this incredibly well, is they have, when you've got a team, it's having people focusing on that metric,
Awesome.
so that if it's customer acquisition costs, it's like, how can we drive this? Okay, how can we drive the value of this consumer? And then everyone is focused on that. So if you're going to add another feature to your software, in what way does it improve on those metrics? And then you can, and the most important thing as well, which I always say, and it goes back to my sales days, it's kind of know your numbers, and recently Yeah, know your numbers. Like, be able to say, well, last month we were at X, the previous month we were on Y. Here we're going to be trailing, and we're looking at that. That shows someone who actually knows their business. So really do know your numbers. And also just touching on the question you had about, like, what do founders need to do to get funding or get noticed by VCs? It is just it's putting that information, obviously, in a sort of a in a newsletter or an investor update, and just sending it every single month, putting a calendar invitation in your calendar and saying, listen, send my investor update. Every meeting you have, every pitch you have, every sort of a person that's a friend of yours, put it on BCC. Obviously, get their permission from a PAPIA perspective and from a GDPR perspective. Say, listen, I'm sending an update. Do you mind if I add you to it? Obviously, have an unsubscribe at the bottom, but it doesn't have to be fancy. Just a text, email, and really about who you are and what you're trying to achieve. And you can put asks there. And essentially, if that's going out to myself, to Knife, to any VC, Sequoia, 500 Global, to your A16Zs, it shows consistency. And then you can look at that mail and go, wow, look all the way down there. Look how this company's grown. They've kept consistency over sort of 48 months. We've got this news. You can actually track to see how the company's done. So obviously that's some bit of advice, because then you can be more efficient, and then people will reach out to you when there's a mandate fit, or they've got funding, or they need something.
So there's actually two things I want to highlight, because what you said now is absolute gold for founders, and I think maybe for reasons that they don't necessarily know or appreciate. But if you do that, you're obviously setting some kind of level of accountability in place for yourself, right? No one likes to report every month that my growth is zero. So if you make a commitment that for the next 6 months at least, I'm going to update these people, which I actually think are quite important in terms of potentially funding my business going forward, in terms of my cost per acquisition, my lifetime value of customers, my churn, and a short little paragraph on what you're doing. If I'm going to do it monthly, first month I report I have 10 customers. Next month, if I only have 10 customers, I'm going to be worried. So I know that email is coming, and I'd love to report that we have 50 customers. So it puts a bit of healthy pressure on the founder to go, let me actually make sure I'm not embarrassed when I send that email. I want to make sure
exactly
I get to report on. I think that's such a powerful tool.
Yeah, and also what's happened is internally within your team. So that's on a monthly basis. But what you can do even on a daily basis, say, listen, Rainier, I need to make 10 calls. I'm going to check in with you at 5 o'clock. If I haven't made 10 calls, I owe you beers, or whatever it is. Or, generally, if there's something that hurts, like I'll give money to the whatever your favorite team supporter club is, or whatever it is. But it's that in itself also drives the micro, and then that's a culture of accountability that you're building into your business, and that's essentially what people want is accountability. Because at the end of the day, if you're going to be taking on some money from the VC, that is the stake, is the sort of guardian of that money. It's not their money, it's the LP's money. They want to make sure that they're giving it to a founder who really does take the job of accountability very seriously, and wanting to deliver growth for those investors and for the employees as well, because that is very important.
The other thing that I want to touch on, which you mentioned earlier, which I think is absolutely crucial, because I see a lot of founders making this mistake. You said give people specific roles within your team. Someone needs to be in charge of getting the cost per acquisition down. And I actually want to make a statement that I think it's important for founders to hire along these lines as well. So don't hire a social media manager or a marketing person. Hire someone that is responsible for getting the cost per acquisition down, because that encompasses a lot of different things, which the title of in charge of marketing doesn't necessarily encompass, right? In charge of marketing is you did all your social posts and the brand looks lekker, but the metrics aren't moving. But if you say in charge of the getting cost per acquisition down, well, maybe that person gets a bit creative and do some other things. So I think that's an important point.
And I think what also entrepreneurs don't appreciate is that they go, I don't have data to show that we're growing, but the bottom line is, if you've got like a social media sort of portfolio, like a handle, just track how many people are following it, and then you can report to that. So you can show the investor, look at our metrics. We've been growing on social media here. Also, if you are running if it is sort of justifying a certain strategy to reach a certain area, spend a little bit of money sort of geo-targeting using Google a certain area to say, well, that is the reason why we're targeting this particular area for our marketing, digital marketing for this product. And then you've got the data, and that is traction. It's like, wow, these people are using data, they're using these tools in a very creative way, and things like, and another thing which is also very important is try to get featured with media publications. So one of our Grindstone companies is actually Inc. Africa, which is a media platform that is looking to promote sort of entrepreneurship in Africa. And we as Grindstone pay them to basically feature some of our entrepreneurs in articles, and that becomes very valuable when you are trying to sort of show investors, but also show potential customers that you actually mean business because you have been featured in a certain sort of publication. So and that in itself is a metric because you can put it there. And then just finally, sorry, I can talk about this forever, but finally is when you have got customers, you'll get a testimonial from them, and get a referral from them. Say, listen, we've done a great work with you. Are there anyone else in your network you'd suggest that we connect with? Because that will then also help to drive your leads and your sales funnel.
Yeah, that's awesome. And so, Will, you've shared so many gems, but in closing, like if someone wants to get in touch with a VC, right? I mean, you've mentioned send them the updates, which I think is great advice. But if you're at that stage where, okay, cool, I want to raise funding, I can just imagine like the demand for funding is way bigger than the current supply for some of the reasons we've touched on. And I'm sure someone like Andrea and Keith's inboxes are full of a lot of people sending them a lot of decks and emails asking for meetings, and obviously have limited time having to raise funding and manage a portfolio. Like,
Yes.
What is that process, and what is the most effective and most considerate way to engage with VC?
So it's generally it's the networks. I think most of the deal flow that comes through a VC is through networks. These are little sort of filters, that says, okay, well, have you seen that company? So it is a case of going through looking at who you connected with them, or who's a trusted partner, to get their ear, so and obviously Grindstone myself is one of those sort of for that purpose, so I guess it would be, looking at your own networks. If you don't have networks, this is another thing which, in order to open up VC, because it has been some sort of comments, and VC in general is like, oh, it's like such a closed ecosystem to get into, but it is basically, building your networks, like basically going to events where most of them will be at, and actually being ready to present and pitch and to share with you what you've achieved. There's very creative ways in which you can get noticed, and that will show what level of entrepreneur you are. Pretty much like I think what's great, and I'll share with you. Most people would say, look at the example of Airbnb when they went to the Democratic convention and they made Obama O's or whatever it was, But I prefer local examples. So for instance, Jonathan from Payfast, he basically took sort of billboard advertising at the airport, and would take out the trick with a lot of these tech events. He would take out a sponsorship at the last minute, like literally the day before the event. Say, well, how much for the lapel sponsorship or whatever, and literally get it at a nice 80% discount. So sorry for any event entrepreneurs out there, but you've got to find strategic ways to kind of to win in this game,
Yeah, and I think that's the truth, really. It's all about the hustle, right? If you're an entrepreneur, it's not only about surviving or getting some customers in clever ways, but it's also about, can you work your way around getting a meeting with a VC? Because that says something about, can you make a plan?
Exactly. And my favorite story of the entrepreneur at the moment, and it's actually a Grindstone Ventures company. So Grindstone created a little seed fund called Grindstone Ventures, which we will then invest some of our for our alumni in that. But Zanele from Wello Health is such a vivacious powerful woman, and her story is so unique around, you know, how she basically sold her car, bought a plane ticket, went to Silicon Valley, learned this whole Silicon Valley thing, lived in a youth, like in a backpackers, you know, and helped at lots of these sort of tech events to get to build a network and stuff, and then came back and said, no, I want to, from being a mining entrepreneur, I want to be a healthcare entrepreneur. I want to actually ensure that people can actually don't have to take time off work to go to the clinic, that the clinic will come to them, you know. So and that just shows the level of hustle, the level of panda that you need in order to get ahead. So it's having those stories that someone like me will tell, you know, on a forum like this, you know. So the fact that I've told that story is kudos to Zanele, and you need those people in your corner who will help amplify your story to the much bigger world.
I love that. Well, thank you so much for joining us. If any of you would like more information on Grindstone, you can go to grindstonexl.com, or Will is quite active on LinkedIn, so connect with him, engage with him there, and you guys probably have some seasons coming up for Grindstone, so I would encourage anybody looking out for some support to look out for that and apply.
Awesome. Thanks, Renee, and thanks everyone for watching.
All right, cool. Have a good one, Nell. Cheers.
Bye. Cheers.